This is Fintech Insider News. This week, Yuno and PayPal team up to simplify digital payments for merchants. The UK innovation economy is apparently booming. And how will the Los Angeles wildfires impact the insurance industry? We'll be discussing this and much, much more on today's show, so don't go anywhere.
Do you know the problem with keeping all your eggs in one basket? One slip, and they all come crashing down. And the same applies for where you keep your money. But don't worry, Insignis Cash lets you spread your savings across leading banks, maximizing security, flexibility, and returns. No more sleepless nights, no more smashed eggs. So get cash clever with Insignis. Visit insigniscash.com now to learn more and get started today. That URL again is insigniscash.com.
Hey there, Fintech Insiders. We interrupt your usual podcast listening to ask a teeny tiny favour. 11FS is in the running for Consultancy of the Year at the 2025 British Bank Awards, and a 5-star vote from you would absolutely mean the world to us. It has been a busy year at 11FS. Not only have we brought you over 120 episodes of Fintech Insider, our ventures team have also been very busy working with global brands to change the fabric of financial services, whether that's designing new digital wealth propositions to helping credit unions all over the world serve younger people better. And that really is only scratching the surface on the great work that the teams have been doing. If you want to help us out, head to 11fs.com/vote or click the link in the episode description to vote for 11FS and help us bring home that trophy. Hello, everybody, and welcome to episode 929 of Fintech Insider. I'm David Brear, and after a bit of a weird recovery, I am back to host this week's show. I'm joined this week, as always, on Fintech Insider News by 3 great guests who are here to break down the biggest stories of the past week in the fintech and financial services space. First up, it is a warm Fintech Insider debut for Catherine Kaupert, who is the Global Head of Partnerships over at Yuno. How's it going?
Very good, David. It's a pleasure to be here. Thank you for inviting me.
Very good. And you've got some pretty exciting news for this week's show, which we'll come to in a little while. But for anybody who doesn't know you and your business, give us a bit of a background.
Well, of course. Well, I'm Catherine Kaupert, Global Head of Partnerships in Yuno. Yuno is a global payment orchestrator, and we facilitate payments for big enterprises around the world.
Very, very cool. And foreshadowing a little bit of what we'll get into a little bit later on. But next up, welcome back to the podcast for Ruth Foxe-Blader, who is the general partner at Foxe Capital. How's it going, Ruth?
Going fantastic. Happy New Year.
Happy New Year. Yeah. It's I can't believe it's like mid-January already. But again, there's probably a story on that. We'll come back to you later. But for anybody who doesn't know Foxe Capital, what do you guys do and how's business going?
Business is great. Foxe Capital is an early stage venture capital firm. We focus on fintech, among other things.
Very, very cool. Few relevant guests. The guys are doing brilliantly, which is awesome. And last but by no means least, welcome back to the show also for Daniel Gold, the CEO over at Stratiphy. How's it going, Daniel? You all right?
Very well, thank you. It's a pleasure to be here.
Good. And for listeners that are not aware about you or your business, give us the pitch.
So we offer personalized investment strategies to retail investors through our mobile app, and we're democratizing access to sophisticated wealth management techniques in a way that is accessible, low cost, and most of all, enjoyable.
Very good. My sort of big prediction for this year was the whole wealth space gets more and more interesting. So I'm rooting for you, Daniel. I'm looking forward to seeing that going from strength to strength. But anyway, as always, great guests. But maybe with all of the stuff that's happened in the news, we should get on with it, shouldn't we? So our top story this week was, and it's sort of every news channel you tune into right now in terms of the horrible things that we're seeing with regards to the California wildfires. And it's hard to almost talk about the knock-on effect of it without trying to get through the sort of cost from a humanity perspective. But the recent wildfires that we've seen in Los Angeles have caused apparently over 20 billion in insured losses, with an additional 60 billion in economic damages. This is leveling entire neighborhoods and forcing really difficult choices for people in terms of where they want to live or where they can live. Apparently, insurers like State Farm have pulled out of high-risk areas, leading some residents to rely on California's FAIR Plan. Not something I know a lot about, but maybe you guys will. The state's insurer of last resort, as premiums in fire-prone zones are surging apparently by over 24%. Some insurance firms, including One Inc., are responding to the crisis by scaling instant digital payments, which is something we can break down a little bit more on that, because skyrocketing insurance costs are pricing out many people from the housing market, particularly as frequent disasters are making mortgages much, much harder to secure. As I said, it's really difficult to get through this story to talk about fintech stuff, given the cost of life and everything in those communities, those people that are feeling this effect. So for anybody who's affected by this, we hope you guys are okay. We hope that your loved ones are. We hope the things you love are as well. But I guess this always has a knock-on effect on the industries that are supporting disasters, and insurance is definitely one of those. It feels like my neck of the woods is suffering from floods, and other parts of the world are suffering from fires. Like this little rock we live on is quite complicated, isn't it? But Daniel, what do you think? Do you think this will have a significant knock-on effect from the insurance industry's perspective?
Absolutely, it's going to have a huge effect on the insurance industry. I think it's important to understand the scale of this current issue. I mean, this is now being reported as the costliest fire ever in the history of record making. Stanford researchers think that this actually could push the insurance industry over the brink and cause insolvencies. So it's going to be a big issue currently for firms facing this. And, there's going to be, I think there's going to have to be some state support at some point for some of the firms. And, in a similar way to what happened with the Silicon Valley Bank crash, the state stepped in and protected some consumers in that case. So that might have to happen here. But in a bigger sort of picture perspective, this issue is not going away. 2024, I read, was the first year where we've breached the 1.5 degree Celsius limit for temperatures relative to pre-industrial levels throughout the entire year. And it's going to, disasters are going to get worse and worse as a result of this each year. So I think that's going to have an impact on the insurance industry and the way that insurance industry measures risk and the way that it deals with consumers and pays people out digitally.
Yeah, I mean, it's a difficult one, I guess, as an industry from an insurance perspective, isn't it? Because, how it's meant to work is there's a big old bucket of risk. You've got people super duper high risk on one end. You've got people super duper low risk on the other. And, everybody's policy is maybe slightly more expensive than they thought it should be. But on an average, everybody sort of benefits from that, doesn't it? In particular instances where we're talking about high fire potential and, like I say, my neck of the woods, Norfolk, you guys are not going to know where Norfolk is. So so the big bumpy bit on the east of England where very, very flat, where basically it used to be the bottom of the sea. So very prone to flooding. The idea that people can't get insurance for floods or people can't get insurance for fire, actually, is that a good approach to risk? I feel like I'm putting words in your mouth that I think it's a bad thing here, Ruth. But what do you think? Is that the model that we should be following, essentially squaring off the curves?
Yeah, no, that's not really possible. I think if you want to have a modern economy, you have to have insurance. It's really the bedrock of people's ability to build wealth and do things that that live life. And so I think I've been actually sort of in and around the insurance industry for more than a decade. I started my investing career at Allianz in Munich and have done a lot of investing in insurtech. And I've also done a lot of investing in sort of insurance propositions that are looking at increasing climate volatility. And I think, a lot of the points that both of you brought up are really relevant in terms of the necessity of figuring this out, which is probably going to be in some ways a complete restructuring of insurance as we know it. that restructuring is probably, going to have something to do with who's bearing the risk, how much risk is borne by different entities, but also just the use of technology and mitigation. These wildfires are certainly the worst, will be the worst losses seen from wildfires in history. But we know that there will be more, unfortunately. And we knew that there would be more in 2017, 2018, when we had the last really big fire losses, and we've continuously had wildfires in the west of the United States and obviously in Europe. Really, really dramatic devastation from wildfires, and really globally, it's a problem. So, I've been investing in solutions that are looking at providing parametric insurance, so relevant to sort of the payment side of things that you mentioned. That very immediacy of paying out the loss is really, really important. The solvency for the industry is a huge issue. I think that, we have the FAIR Plan, which backstops homeowners that the industry has deemed uninsurable, but those the insurance payments that homeowners will recover who are using the FAIR Plan might not be enough to cover their needs. And the FAIR Plan is also backstopped by the insurance industry and by reinsurers. So the losses are really going to be widespread. I think, in addition to the devastation and just the human toll and really the trauma of such dramatic loss of not only sort of personal property, but also communities, there is just a strong need for us to be realistic about increased climate volatility. The fact that, we have global warming, we have very extreme events, and just even going into how extremely dry California was and Southern California was, and how predictable this was. The Santa Ana wind event, this isn't the first time that it's happened. It's quite common. But then when you have just absolute low levels of rainfall, if you have, any sort of brush fire or spark, there's a huge risk of wildfire. So ultimately, we're also going to need to use technology to mitigate. A lot of the insurtech propositions and some of the ones that I've invested in have done an amazing job of deeply understanding risk and building superior models and really bringing data to this kind of law of large numbers industry. But we're not going to solve the human dimension of this problem just cherry picking good risks. We need to be able to protect everyone.
Yeah, I completely agree with that. And it's not really a risk bucket if you're just cherry picking all of the no risk or low risk, aren't they? What's the old saying? It's preventative is better than restorative when it comes to insurance, right? And to your point, for all of the elements around data, people could have seen this coming. To all of the points that you're making, I guess. And Catherine, to your industry, from an insurance, from a payments perspective. A lot is being made here about the speed of people being able to get access to payouts of things. That's obviously something that touches on your industry from a payments perspective. What do you think about that? Because I'm in two minds of it. Having been in insurance for 6 years and been in banking for 6 years, the banker in me is like, yeah, give me instant payments. The insurance person in me is like, I'd really like to keep hold of those balances for as long as possible because that's how my business model is made. So it's an interesting balance, I guess, just because technology allows us to do it. Like, Ruth, to all your point, the one-to-one risk modeling we could do with ridiculous advancements in data that we could do for analytics around cars, I don't know, whatever. Just because we could do it doesn't necessarily mean we should do it. But that was a really long question, Catherine. Good luck with picking the bones out of that one.
No problem, David. No, yeah, very, very sad, unfortunate, and yes, there is no way to prevent this with data or AI or anything. But in terms of instant payment and what people and companies, like people, are expecting from their insurance companies is exactly that, no? Instant payments. And it might sound easy for us that are in these industries and know about it, but unfortunately, not all the companies are aware of this. And to give you some data, during Hurricane Ian in 2022, insurers that adopted digital payout methods through fintech partnerships, reduce claim settlement times from 4 weeks to 5 days. So imagine you are one of these person that is affected during this emergency and you need to do this claim and you want to get your money right away because you need it, like you are under enough. So definitely that's how fintechs and companies like Yuno are helping during these type of situations and horrible disasters. But I would like to also mention another data point on that, and it's like 78% of customers expect instant payouts during emergencies, and only 81% would switch to a provider offering this service. And that's something whenever you are going through these insurance policies, when you are buying a policy, you can read and then you don't understand the impact of it. So imagine these people going through this horrible experience and then getting to experience a company answering them like, yeah, you have to wait for a check to get to you, like a paper check. Well, you can claim it like that. That will be the worst ever. So
you know,
it's
I
very...
bet some of their back end office structures will only send checks to your house. The irony of that, you know, the issue with that situation, given obviously what we're talking about, like it is weird, isn't it? The process there. Often with insurance, you don't know you've got a bad one until you need them. Sadly, exactly like you say, Catherine.
Exactly. And not only insurance company, but also payment methods or just sending money. Like these people are receiving help from their families outside the country, or not only about the wildfires, but any natural disaster. The importance of digital payments is very, very relevant. They need to get housing, they need to get food, they need to get shelter, they need to buy flights. And if they lose everything or access to their credit debit cards, like it might be difficult to get access to their money and how to solve all these problems that you might have, especially when you are going under a situation of stress like this. So digital payments, access to different ways of receiving money or sending money is very relevant during any disaster.
Definitely. Yeah, I mean, any point of absolute need, you want that process to be as slick as possible to, you're already under enough stress, as you say, then adding to that with waiting for disbursement of funds is not something you need to be doing, particularly if you're looking for somewhere to literally live, So I think we could probably talk about the impact of this one, and probably will be as this unfolds further and further in future weeks. But we probably should move on and talk about the other things that are happening. So the next story that we saw, and this was one that hit the 11FS Slack and sparked quite a lot of interesting debate, actually, was first seen on City AM and a bunch of other places picked up after that, is Freetrade has been bought by IG. So this is IG Group has announced the acquisition of Freetrade, a UK-based stock trading app, for £160 million. The deal is expected to complete by mid-2025, pending the regulatory approval required to make that happen. Freetrade has 720,000 customers and 2.4 billion in assets. In 2024, it achieved a 32% revenue growth to 27.5 million and reached profitability for the first time at that point as well. I think this is a super interesting one, and Daniel, worth coming to you first on this one, not because you're just first on my screen, but actually because I guess it's your particularly your area of expertise when it comes to the wealth thing. I find this quite interesting. I mean, Freetrade seem to be doing really interesting things and good things. I'm a customer myself, and I'm also a customer of a big bank share buying process. I can tell you with definite which one I prefer using on a day-to-day basis because of, for all of the reasons you would expect in terms of their service and their interfaces. But I mean, does this seem like a strange ending or exit, given the types of scale of the money that we're talking about?
Yeah, it's. I don't know if it's a strange exit, but I've got a few thoughts on it. It's definitely a space that I'm familiar with, and it's a space that we are closely operating in. I mean, in terms of the value of the exit, I think it's lower than probably most people would have expected or wanted for this company, given the trajectory and the fact that they changed the face of the industry so much. I think they really introduced the concept of commission-free investing to the mass market. and opened up investing to a whole cohort of new people and made it something that young people are excited about and talk about. And I've been following the business from the early days. And I can remember when they started, there was so much buzz on the community forum talking about, investing and talking about what customer number they were and, what level they invested at. And the other aspect to this is that they opened up investment into fintechs for a lot of people. So they raised money on Crowdcube in a number of different rounds. And that was a great experience for many people, but the value that they've exited at is a good thing or a bad thing, depending on where you got in.
Yeah.
So a lot of people would have made a lot of money, but those are the people who got in early when the valuation was in sort of the 10s, 20, 30 million. The valuation of the company went up to, I think it was like 600 or so million before dropping back down into the sort of 200 million range. But all of those people are losing. So it's kind of a mixed bag, really, in terms of what you think of the valuation, but it's certainly lower than what people would have wanted. As I say, it seems a bit cheap in the market, but we're not privy to the information that was available to the deal makers. What I think the perception is in the market is they probably struggled with monetization. Their whole proposition was around focusing on kind of people who want free investing. So those are by nature low value customers. Whereas if you look at the other exit, the big exit that happened in the last few years is Nutmeg, who got sold to JP Morgan for, I think it was 700 million. They had far fewer customers, but every pound invested with Nutmeg is monetizable. So it's a more high value add product. So I think the moral of the story is it just comes down to the value of the product, not the number of customers, in terms of the exit value here. So it's that I think they've got an interesting future, though. I mean, they've teamed up with a very big established company with deep pockets, and I think they'll do interesting things together.
Yeah, it's an interesting one, isn't it? When you see, and inevitably in the market, in the world we live in right now, with funds a little bit harder to get hold of, then you sort of expect there'll be many more of these types of things happening, Ruth, I would have thought, because actually as money becomes more difficult to get hold of, big companies look like great opportunities to strategically go in the direction that you wanted to, even if you're sort of changing the dynamics of the business. Is that right?
Well, as an early stage venture investor, I hope not. I think this is a really disappointing exit. Without, I don't know, the English audience, you're all very polite. But I think that this is really maybe a little bit of a bellwether for the part of the cycle that we're in right now. It feels like the market has been correcting pretty substantially over the past couple of years. Particularly given the cash inflows, the kind of Trump bump cash inflows, which, we saw yesterday, the big banks' earnings just absolutely blown out of the water in the US. And, this we see across, anybody who's dealing with retail trading. That was just a really great Q4 was this moment where lots of folks were racing to get into the market. And free trade, obviously, beneficiary of that trend. But the trend that they're not a beneficiary of, I guess, is this overall market correction and multiple compression for fintech companies. I mean, as an investor, I find it highly concerning.
Well, as you say, as an investor, I think they took nearly 160 million as brought in money. But that doesn't leave for a lot of benefit to the investors or the founders, I guess, either, right?
Yeah, it's really scary to see, a company being sold and not necessarily clearing the pref stack or barely clearing the pref stack. I think what I would say is that it's an opportunity for founders to think about how they want to build businesses. And we've gotten very accustomed to an environment where it's actually quite easy to raise capital. There's been a lot of kind of discretionary capital floating around the markets, since COVID. And I think that the discipline has sort of gone out the window. And it's just important to be lucid, right? Like there are still companies that command absolutely masterful multiples, and where it really makes sense to deploy extraordinary amounts of capital into building things. I would say, also with just the way that software is changing because of LLMs and AI and things like that, it just really merits consideration around what is the appropriate amount of paid-in capital for a startup to take while it's building a business, and what that looks like. Because at the end of the day, it's really the founders who, ultimately are devastated by acquisitions or exits, liquidity events where the pref stack isn't cleared.
Yeah. What do you think, Catherine? I mean, it is obviously a very different market than back in the heady days of 2015, 2014, when VCs were just, how big a cash bag would you like, to do the things? And is there AI in this? I'll give you some more money. But the world's quite different now. Do you think this is a sort of a sign of things to come in terms of that consolidation by bigger companies, or do you think that market will change again? Because I guess every cycle has a cycle.
I agree with you. I think every cycle has a cycle. I guess that thinking from the startup of fintech standpoint, is very important to understand the scalability or how the project could evolve. So I guess like investors are paying more attention to what's the vision, and I think today AI is standardized. Like that is not a differentiator anymore. They're thinking about, okay, what's next and what's the vision and how these companies using these tools in order to get to they are selling me they're gonna get. And I think it goes more, in my perspective, to the human point. Like, what is your team? What is the vision? What are your ethics, your values? Like, what are you envisioning on how you're going to be different from the rest of the startups or initiatives that are around the world? And I believe that now that we have AI, and I'm sure everyone in this forum uses AI continually, but now that becomes like it was like 2 years ago to use Google. We used to consult Google every time. Right now, AI is like in every day, in a lot of moments of our day, in a lot of softwares that we use, in a lot of interactions that we have with the world, with your business, with your personal goals. Like, it's involved in everything. So from my standpoint of view, it's standardized today, and that's when it takes us back to the human part. Like, you connect when you're a startup or a fintech, like, with the investor, because what they see in you. Like, the project, of course, is important, the vision, the mission, what problem are you solving, but it's like, okay, who you are, what you and your team have in mind in order to make this happen. So I will say, like, okay, going back to the human part is what is relevant today.
Yeah, I guess. Maybe coming back to you, Ruth, on that point. Given you're the VC in the room, I don't want to put all of the pressure on your shoulders to answer this on behalf of the entirety of the industry. But it's definitely a lot harder to get money for people. But that's not necessarily a bad thing, is it? Really, to your point earlier on around, and to what Catherine's saying here around actually, the focus of good business fundamentals. It goes back to what Daniel was saying. Maybe free trade was a bad name. Maybe it should have been slightly cheaper, but still some money paid. Because then at that point, there's a big business model to kind of grow out from it. But is it a bad thing that it's harder to get cash, or do you think that's just building good fundamentals into the startups that we're seeing actually starting up now?
So I think what I would say is it's venture, so there are no rules. It's hard to get cash for a lot of people. It's easy to get cash for some people. There are still rounds that we see that look very much like 2021. So I would say maybe the mood music is a little bit different, and depending on what your company's doing, how long you've been around, what the kind of underlying unit economics look like. To your point, it might be more difficult. There are certain funding stages where it's more difficult to get capital. I think for some companies that are working in certain spaces, not only AI, I think we all like to beat up on AI, but certain geographies, certain themes. There are founders that are handily raising capital and have competing term sheets, and great investors are still working, and so investors are still working, and it's investors' jobs to deploy capital. So I think I guess market corrections are always healthy, maybe by definition. And so, yeah, to your point, does discipline make sense? Does it make sense to care about unit economics? Yes. At the same time, venture is about big swings and moonshots and, things that sort of fundamentally either change technology or the way that we experience the world. And so I think it's really easy to sort of play Monday morning quarterback with, disappointing outcomes for companies. But companies, to Catherine's point, are in some ways very human. They're human driven. It's easy to be imperfect, and it is it's easy to fail at different things. I think that there's still a lot of capital chasing big dreams and big ideas. I think the questions are around how investable software is at this point in time, and how much we're going to see sort of technology getting a premium when it comes to multiples, sort of exit multiples in companies. And I think that the point we're getting to is you get a technology premium when technology is making your business more efficient in some way. Either it's, cutting costs or making you more profitable.
Yeah, definitely. I completely agree with that. And actually, to your point, that's going to unfold as the months and the quarters go on, aren't they? But there's definitely no shortage of people wanting to, use money to make money, i.e. invest in things that will do that. But maybe people are just going to get a little bit more picky out of what those things are. So on that note, we're probably going to have to wrap up this part of the show. We'll be back with you very shortly.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Hey there, Ryan Reynolds here. It's a new year, and you know what that means. No, not the diet. Resolutions. A way for us all to try and do a little bit better than we did last year. And my resolution, unlike big wireless, is to not be a raging and raise the price of wireless on you every chance I get. Give it a try at mintmobile.com/switch.
$45 upfront payment required, equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes on unlimited. See mintmobile.com for details.
All right, folks, welcome back. Before we get back into the news, we wanted to tell you about our first community event of the year. Open Mic Night is back in London. Not that any of our guests can come along to that, because none of you lot are in London, are you? But for everybody else who is in London, it's going to be on Wednesday, the 19th of February. We're going to be taking over the Joiner on Worship Street in London. Again, none of the guests have got any idea where that is, but it's a nice place in London, I assure you guys. For a no-holds-barred conversation as we discuss the trends that are going on to shape fintech and banking in 2025 and beyond. I'm going to be on hosting duties that day, and I already guarantee it will turn into at least a 2 or 3 pint type of show. If people have not been before, you'll get what that means. And all of your favorite Fintech Insider hosts will be there too. Tickets are free and going super duper quickly, so if you want to come along and join in the fun, just head over to Eventbrite page on the show description and grab your ticket now. All right, back on with the news. All right, this is one we picked up first on Bloomberg, but again, covered in a bunch of other places. A Blackstone-backed wealth management firm catering to India's affluent has expanded its operations by opening an office in Dubai. The firm aims to tap into the growing Indian diaspora and high net worth individuals in the UAE, offering bespoke financial solutions. Dubai's strategic location also appeals to wealthy investors to make it a hub for firms' international growth strategy. Daniel, it makes sense just to cut. I feel like I'm going to have to go to everybody else on the next questions just first. So, Ruth, Catherine, you've got it first next time. But Daniel, it makes sense to come to you on this one. What do you think?
I mean, this is certainly a win for Dubai. Getting a name like that on board, it reinforces its position and its aspiration to become a global financial hub. As the article says, there's a growing cohort of wealthy Indians who want to access international markets, and they actually form the largest expat community in the UAE. I read there's actually about 3.5 million Indians in the Emirates. So it's I think that's like 30+% of the population there. So it's a huge customer base. There's obviously a lot of capital now in Dubai with money flowing there. So this allows a firm with strong backing to access the market there. And so it makes a lot of sense for ASK to open up shop in that market. But I guess the question is where this can take wealth management in that market. And unlike a lot of other financial centers, Dubai is really on the rise right now. It's got a lot of momentum behind it. Firms are opening up, capital's moving there. There's a lot of exciting IPOs. So my guess is if they continue to build on this momentum by attracting more firms and the human capital that brings, it will attract even more investors, and you get some kind of virtuous cycle. That's what I guess they're trying to work towards in terms of their strategy for the center. So it seems like they've got every chance of making that sort of thriving ecosystem happen in the market. And that can even steal some business that would have traditionally gone to centers like London and New York. So certainly a center which can compete with us and one to keep an eye on.
Yeah, it is amazing. I mean, the advancements we're seeing, Middle East more broadly, Saudi, Dubai, et cetera, et cetera. I mean, the advancements in investments, developments, it's not just tall towers going up. It's, gigantic financial services organizations getting in on those acts as well. So as a point of evolution, we've seen, the UK, Singapore, Hong Kong, really the Middle East seems like it's the next big, literally and figuratively hot space in that regard. But Ruth, are you seeing a lot of money from an investment perspective going that way?
Me personally, not so much, but it's just I guess we invest globally, and there are just venture investors, as I kind of mentioned before, I think are looking for ways to improve fund economics in the wake of kind of this correction. And I think that, being able to look at markets where infrastructure isn't as mature, or there are huge customer bases that are untapped, is certainly something that we're all interested in doing.
Yeah, definitely. And if there's a region of, one of the highest regions, like something like Dubai, of, you can throw a stone and hit a millionaire on every corner type thing, then it's not a bad shout to be building a business out there if you can do it well, I guess. But Catherine, obviously payments are a global thing. There's no way you can work in that space without thinking about it in a global regard. I've definitely seen some of the really big players kind of look at the market. I guess as any expansion to any market, regulation and everything that goes with that is always a bit of an inhibitor. But you guys must be keeping your eyes out on all corners of the world, I would have thought. I feel like you're about to give away product roadmap secrets, though, so feel free to tell me to bugger off if you want to.
No. So, we provide connections to providers of any kind in the payments industry. These could be fraud solutions or pay-in solutions, payout solution. Like moving money around the world is not as easy as people think. So, and from the wealth management firm side of view, you need someone that solves those problems for you. And that's a big pain, not for only wealth management firms, but for most of the companies that have operations regionally or globally. The complexities of management payments and at the same time maintain the service you are offering your customers is a lot. And as a as a company, you need to focus on your business. If it is wealth management, that is your business. It's not handling payments or making sure the payments are secure, and everything affects at the end the customer's experience, and that affects your business at the end. So taking care of this is very, very important, and managing a global business from a broader perspective is even more complex. So right now we're seeing a lot of ambitiousness from all corners in the world, all type of companies, and some of them want to conquer the world, especially wealth management. We're talking about money from Dubai, money from India, money from like all these countries that are currently holding all this money that investment firms want and wealth management firms want. So you have to pay attention and become a global company. Managing this level of complexities is very, very difficult. So you need someone that takes care of that and maintain your service levels.
I'm definitely not going to ask Daniel this one because he'll definitely tell me yes. But Ruth, when we were talking about wealth a lot on this show, increasingly with interesting people doing interesting things in that space, but it feels like each sort of slice of financial services has had a bit of a time in the sun. Retail banking had a little big bit. SME banking had a bit of a investments had a is wealth, do you think, the sort of next frontier when it comes to that side of things? Because there's a lot of problems unsolved, but they're all pretty big, difficult to solve problems, aren't they?
Yeah, but big, difficult to solve problems are great startup ideas because there's a big moat and the potential to build a really, really valuable company. I think when I think about what are the drivers for building interesting companies, one of the things that we always think about and look at are demographic shifts. And so this kind of baby boomer wealth transfer topic, I think, is super, super interesting. And I think that what you have is an opportunity not only to be sort of assisting with that wealth transfer, but also really confronting the attitudes and assumptions of new generations of investors that are kind of coming online and have really different expectations for the way that they invest, the way that they're handled, the information that they get, and the way that they kind of interact with financial markets.
Oh, I'm glad you said that. It would have been really awkward with Daniel for the rest of the show if you said, "Nah, there's nothing in wealth space." That would have been just really awkward. But
venture is a game of exceptions. There's something in every space, but you just have to build something exceptional.
But I'm glad you said that.
All right. On that note, we'll leave this story and move on, though, because there's a lot more to get through, and I'm respectful of people's time. Okay, so the next story that we had was one that was picked up over at Fintech Finance and a bunch of other places as well. This is Yuno and PayPal team up to simplify digital payments for merchants. So Yuno, the leading payment orchestration platform, has partnered up with PayPal, tiny little company in the payment space, so that's a great partnership to do, to offer PayPal's secure and flexible payment options, broadening their market reach and unlocking new revenue streams. Yuno now supports over 300 global payment methods, making it easier for merchants to offer the most popular and locally relevant payment methods in each market. I'm definitely not coming to you first on this one, Dan. So, Catherine, tell us more about this. It's obviously been a busy week in your offices.
Yes, thank you, David. So I think I would like to start maybe talking about Yuno from the people that are not familiar with the concept of payment orchestrator. I would like to say that we facilitate connections to payment providers around the globe. So we are a global payment orchestrator, meaning that we provide our customers, mainly enterprises around the globe, with just one connection to Yuno to access hundreds of connections around the world. As you mentioned, we have more than 300 payment methods around the world in every region of the world, and we partner with companies like PayPal. So, as you mentioned, a very important logo in the payment industry. And I would say that at the beginning, and I don't know if we can go about 15 years ago, PayPal was this wallet where you could pay something online. And I think that basically our generation might get stuck with thinking about PayPal that way. but there is much more than PayPal offers in the payments industry, and is definitely a key partner for Yuno. And there is something especially about this partnership, and it is our first global partnership, because usually these global providers operate regionally, taking care of the particularities of each one of the markets. So partnering up with PayPal is a very important stage for Yuno. We started with Latam, and because of the relevance of that they have in Brazil and Mexico, but it made total sense to make a global partnership. We provide services to enterprises in all industries. So think about all these merchants that have operations regionally or globally. They are our customers, and through one access to one platform, they can manage all their payment methods. If they are expanding, as I mentioned previously, to other regions of the world, or they are in need in new payments to offer their customers in these new regions of the world. So every time we start offer our services to these customers, we open our portfolio of connections and facilitate all these to all them, so they can focus on their business. We want to do all the heavy lifting on the payments space, so they don't have to worry about it. We offer them features on how they can manage their payments, like reconciliations, insights, among other things. But that's the pain we're offering for these big merchants that have operations regionally or globally. Open to questions.
I mean, it's super interesting because actually, I mean, it wasn't long ago, I remember PayPal wanting to build everything and do everything. And actually, a partnership like this between organizations to kind of the overlapping elements of these things to take it out to all the different types of merchants across the world. I mean, it's an interesting step for you and them to take, isn't it, in that way? But it's also, as you say, it's not a bad logo to sort of have from a distribution perspective. I often... I think PayPal at the beginning was almost they were solving for laziness, as in I'm too lazy to find my wallet, therefore I'm going to use the button. But as you say, they've gone from strength to strength in terms of all of the different things that they do, haven't they? So, but I guess for you and them, it opens up new opportunities, doesn't it?
Definitely. Our ambition is to serve merchants all over the world, and that's why we need to partner with companies that offer services all over the world. So that made total sense.
Very good. Ruth, Daniel, sort of bringing you into this, what do you think? Is again, this sort of, rather than everything being on your own roadmap, but actually partnering with people who have done some of that lifting for you as well, that seems like a very sensible approach to making these things happen.
Absolutely. I mean, first of all, congratulations to Yuno. That's a fantastic deal. And well done. I think you're absolutely right, though. I mean, partnering up, specializing in what you do and doing that really well, and then partnering up to get peripheral services or access to new markets or additional revenue streams makes a lot of sense. We're doing that at Stratiphy on a smaller scale, working with other companies to introduce services that is not our core competency and leaves us to focus on, generating the best algorithms, generating the best portfolios and the best customer outcome. So it's something I think that is probably a trend in the industry, in industry as a whole, because there are so many specialist firms now, and I think we'll see more partnerships like this. Whereas I guess you can contrast that with the approach of companies like WeChat in China, or perhaps you can talk about Revolut over here, who are trying to do everything on their own. There are different approaches in the market, but there's certainly a lot of mileage in partnerships.
Yeah, definitely different regional approaches, different requirements from regulators or governments to that as well. So there's particularly when it comes to payment rails, I think there's an interesting approach for everywhere, isn't it? It's one of those ones. It's like plugs. It all sounds like a good idea to get electricity, and then somebody makes the plug different on everything. So, but you guys, Catherine, I guess, have gone through that pain with integrating into all of the different things that you've come across in order to make that useful for customers. But Ruth, I mean, we talked about retail and commercial, but payments was the sort of advent of fintech investment, really, wasn't it? And actually, it's sort of, again, talking about cycles having cycles. We've gone full circle, and payments are really big again. In fact, actually, many of the companies that are within this space are really big as well.
Yeah, everything old is new again. I actually made an investment in a payments company last year. It felt so old-fashioned. But I think that what we are seeing, it really goes back to our previous conversation. And I also want to join Daniel in congratulating Catherine and the team. It's awesome. It just shows that I think that large organizations and also startups really benefit from building infrastructure where it doesn't exist. And I think, we see sort of the opportunity to build competitors in mature markets because either we know and understand them or, we feel like it's somewhat known. But actually, I've been so excited about investing in a bunch of different regions, including Latin America recently, because, just the opportunity to build critical infrastructure is there. And when you are in that infrastructure space, it's extremely sticky. It's hard to rip out. It helps a lot of people and brings opportunities to customers and economic opportunity to regions. So very exciting.
Very good. And as you say, the regions where actually that sort of underlying infrastructure is changing so dramatically, they sort of benefit from all of the other regions that have made serial mistakes potentially in terms of how those things have been done in. So, learning from what's happened to do it more effectively in other places, that has a ripple effect globally, doesn't it?
Yeah, we always used to talk about leapfrogging and stuff like that. But there's certainly opportunities to do that. And, just whether it's infrastructure, whether it's stable coins, we're just going to continue to see money move differently. And some of the kind of core beneficiaries of value are going to change.
Absolutely. As everybody said, congratulations, Catherine. You'll have to come out and talk to us again as things sort of progress and as things change. But congratulations. Okay. For now, we're going to take a bit of a quick look at the stories that we don't have a lot of time to cover. Like this show would have to be about 5 hours long if we covered everything in depth. But we don't have time for that, unfortunately, and I doubt you'd have time to listen to it either. So we're going to whistle through a few stories. The first one was one that was covered in Business Cloud and a bunch of other places. Is that the UK innovation economy is worth a combined 1.2 trillion. This is according to HSBC Innovation Banking release on their Forward Look Innovation Report for 2025. So according to this newly released report, the UK innovation ecosystem reached a combined enterprise value of 1.2 trillion in 2024 and a 20% increase from 2023, with startups now employing over 1.8 million people. So that's double the number than in 2020. The UK remains Europe's largest tech ecosystem, raising 16.2 billion in 2024, more than Germany and France combined. Sounds like I'm bragging. Like it comes off badly with the English accent, doesn't it? I don't mean it like that way. Germany, France, we love you too. And minting 9 new unicorns at a total of 181, representing 31% of Europe's billion-dollar startups list. AI startups raised a record 4.2 billion in venture funding, a 31% year-on-year increase, while fintech reclaimed the top-funded sector with 3.9 billion in VC investments, driven by really big major rounds in things like Monzo and World Remit. The new report follows Innovate Finance's Global Fintech Investment Report, released last week. The UK trade body research showed that global fintech investment fell by 20% in 2024 amid pretty tough times, to say the least. I mean, it's a funny one. I always take these things with a bit of a pinch of salt sometimes because report from London says London's super important. No doubt it is, given the sort of might of the financial market. But equally, I used to get a lot more pounds for my dollar than I used to get. So that's concerning. So, hopefully a lot of these things all add up to a great environment for startups, the regulatory climate that we really, really need, but actually a really, really stable economy for everything to build from, because all of that don't work without that bit working. So let's see where we get to that next. We will put a link to the report in the show notes, so go check it out anyway. All right. And finally, bringing it a bit lighthearted, we started in quite a sad place, didn't we, with everything that was going on, and understandably so. But actually, I'm told that it has been National Quitting Day. didn't even know this was the thing. Apparently it is. But we're recording this episode in the wake of National Quitting Day. The 12th of January usually marks the day where around 80% of Americans give up on their New Year's resolution. On last week's pod, we discussed our fintech New Year's resolutions, but this is literally every New Year's resolution. I think I should probably start this one with Ruth. Did you have a New Year's resolution?
No, not really.
Did you not?
I mean,
so you didn't even have one. You didn't even have
Yeah.
one to quit doing
National Quitting Day is every day for me.
Yes.
Is what I'm telling you. Yeah.
Yeah, I mean, I mean, if you don't make the commitment, it's really easy because you never quit, did you? But Catherine,
Right.
did you have a New Year's resolution?
Yes, I do. I have a very long list, but
Yeah.
I could share with you one. Working out from Monday to Friday because I used to do it Monday to Thursday, and
So
I
you
haven't
added-
quit.
I'll be honest, that makes me sick. The fact that you were doing it Monday to Thursday and you added another day into it when I was like, I might do it twice a week. Like that's, I find I'm offended by it. I'll be honest, but I'm not really. I'm joking. Daniel, did you have a New Year's resolution?
Not particularly. I mean, I have continuous resolutions. I'm not meaning to copy, but it's, also to work out more, maybe cycle into work or something.
Continuous resolutions. I like the idea of that because technically you never quit those either, do you? I see what you did there. That was good. So we've got a range of Catherine making herself work harder, Ruth not even committing to something because she didn't want to quit it later, and then you just moving the goalposts to continue.
No, I wanted to quit it.
Yeah, you wanted to quit it
day.
every day. Oh, okay, fine.
Every morning I wake up and I've
that's
already
fine.
quit.
But I feel like there's something very zen about that though, right? Because you start with a blank sheet of paper every day, don't you? So it's all about new commitments at that stage, isn't it? So do you know what? I didn't have any resolutions either. But with being sick last year, I think my resolution was to take less sick days, basically. But maybe that's not a good one, is it? To basically throw in there. But
I think it's a very good one.
well, I mean, definitely my after all of the talk about insurance earlier on, my Bupa insurance would definitely prefer it if I was ill less. But I think, it's a strange thing that when you sort of get into what we should quit. I mean, there's an interesting long list of things that I think maybe the industry should quit as well. But I reeled off what AI is it? Tell me about AI. Like that's definitely something I think as an industry we should quit. Acronyms much more broadly, making financial terms sound incredibly complex just to make ourselves feel clever. Is there anything that you think from an industry perspective we should quit?
I can think of one of erasing unnecessary meetings
Erasing
for
us, yeah.
everyone.
That would be great. I think I would free up possibly half of my week at times, given the scale of some of the organizations that we deal with. But that would be nice. I'd spend more time with my loved ones and my family. That would be awesome.
I
Ruth,
invite you all to do that. It's good.
yeah, okay. Well, I'll tell them you told them to do it, but we'll see what they say. Ruth, Daniel, anything you think the industry as a whole should quit? I feel like I'm really putting you on the spot here, but let's see how.
I mean, I'm really reticent on this because I feel like I just am likely to offend. So I'm just trying to, I feel like maybe quitting LinkedIn posting and maybe certain kinds of posts there's some stuff, but then it provides so much humor. So I think maybe zen is the word. I'm not sure.
Yeah, you're coming out real zen. I like that though, but
Thank you.
I don't. I never suffer from that. I've usually said it before I usually regret it. So who on LinkedIn? Say their names.
Oh,
I'm
no.
joking. I won't. I'm joking.
No.
Daniel, anything you think the industry should sort of maybe not quit, but just cut back onto a healthy level?
Yeah, you kind of mentioned it in the start, actually. I'm going to say it's a bit, controversial to some people, but, AI, I don't think we should quit it. It's certainly got its place and it's got great applications and great potential, but it's not the solution for every problem.
Yeah, no, I'm with you on that one. It's definitely not the thing that'll get Ruth chucking investment money at anybody anymore. They're a bit.
I don't know. I mean, the US might be about to quit TikTok. That's exciting.
Yeah. Well, I mean, I mean, back to Catherine's point about potentially freeing up 2.5 days a week, then based on people's screen time usage, that might give a lot of people a lot of productivity back, won't it? But on the AI point, and I'm going to go way off on a tangent here, and the producers are going to hate you about it. Most random thing I've seen AI used for over the last week. Has anybody come across a company called Pickle? Have you guys seen this one? So
No.
Pickle will do a full avatar for you. So after working with the algorithm to create an avatar of yourself, that means it will send the avatar to meetings and sync to
Great.
your voice for you. So
Awesome.
now, you guys are much more handsome than I am. I don't spend too much time doing my hair, but just the amount of saving you, putting on makeup, doing your hair, turning up to meetings, you could just dial in and it will do it moves like you do. It
Oh, wait, you
interacts
still have
and
to talk and
gesticulates.
be in the meeting?
Oh, well, come on. It can't do everything for you. Like,
No,
if
I'm
somebody
ready
asks
to
you...
be replaced. I mean,
You're ready?
yes.
right.
Bring singularity.
Well, on that note, we're going to go now and plug Ruth into the Matrix. But for everybody else, then, yeah. But I would check it out, honestly. It's a bizarre one. I'm playing around with it now. For $29 a month, I will never have to have a shave or do my hair ever again. All right, on that note, we are going to have to wrap up the show, I'm afraid. So that is everything that we've got for you this week on Fintech Insider News. Thank you so much to the guests for coming along and chatting along and humouring me after being away for 5 months. I do appreciate it. Where can people learn a little bit more about you and the business that you run? Catherine?
You can learn more about Yuno at y.yuno. That's our website. And of course, you can follow me on LinkedIn. Sorry, Ruth. And thank you, David, for having me here.
No problem at all. Ruth, I guess people can't find you on LinkedIn at that point. Then you're going to go...
They certainly can. You can find me on LinkedIn. You can sign up for Fox Capital's newsletter, Fox News. And you can check out our website.
Very, very good. Daniel, where can people learn more about you and your company?
You can find us at www.stratiphy.io. That's Stratiphy with a PH. You can also download our app from the App Store and the Play Store. And you can find me on LinkedIn.
Very, very good. As for me, do you know what? I'm going to double down on the crazy LinkedIn posts and just start tagging in Ruth, I'll be honest. So you can find me over there. Thank you so much for listening, everybody. And for everybody who's tuned in or contributed to this week's Fintech Insider, super, super appreciate what you've done. If you like what you've heard, please leave us a review. It helps other people find the show as well. And if you really, really like what you've heard and you want to get involved, drop us an email at podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.